Let's get across the market open now. Kyle Roder joining us from capital.com. Kyle, good to catch up with you on this Friday. Let's first start in the States. Equities continuing to come under pressure. What are you seeing there? Because all of this sort of stemming from that uncertainty in regards to global trade and tariffs.
Yeah, it's basically trade war whiplash at the moment, and effectively, despite the fact that we got, another reprieve from the Trump administration that, goods covered under the USMCA will be given another sort of delay in tariffs until at least April 2nd, did very little to kind of calm sentiment on the basis that, or calm nerves, I should say, and improve sentiment on the basis that still it looks as though those auto tariffs plus those tariffs applied to goods on the USMCA will continue to go ahead on April 2nd. And on top of that too, there seems to be kind of an incoherent policy from the Trump administration when it comes to trade, which very much gives the perception of basically just improvisation with this very important issue, and it's a very difficult time as a result for the markets in trying to price in what is now looking like, again, no sort of clarity about what the Trump administration's actual trade policy is and what ends that it's actually trying to achieve with this trade policy. So we've got that element of, really shaking up market sentiment, the downside risks to growth that presents. And then, on top of that too, there's probably a degree of positioning going into this non-farm payrolls release, which, is looking like it could be one of the more volatile jobs releases over the, in the last couple of years, really on the basis of, what impacts things like the Doge cuts and the public sector layoffs might actually have on the overall jobs figure.
What are you expecting in the Asian session, Kyle? What's not a lot of data, certainly not locally at least, other than household spending here in Australia, more broadly in Asia?
Yeah, we'll still be sort of digesting what's coming out of the MPC, which admittedly the news flow has kind of slowed down over the last couple of days since those big initial announcements at the open of the summit. It looks like we will see a bit of a drop at the open for most major indices. The ASX 200, has failed to kind of participate in the upswing that we've seen in, Asian markets and, even European markets as well, which is sort of benefiting, from this planned remilitarization of the bloc and, the very significant fiscal spending, the expansionary fiscal settings that will entail. Even yesterday, of course, when we did see that Wall Street rally on Wednesday night, the ASX 200 didn't participate in it at all, and it would appear that we might sort of plumb probably 3 or 4 months lows to today, which would more or less erase the gains that we've seen for the market this year. But I mean, for the most part, I think there's going to be a degree of positioning again going into these non-farm payrolls figures, just like there was to a degree last night on Wall Street. If we're going to see any kind of proppiness in the market today, it's probably going to come through during the Asian, Hong Kong and Chinese Open, to see if we sort of see a continued sell-off there on the basis of the lead that we got from Wall Street last night, or whether there's some of these headlines coming through from the MPC continues to push these markets higher, which it has in the last couple of days. So again, very, very much a vacuum today for investors, especially domestically, but one suspects that it's going to be a fairly weak start to the session.
Now, we're also seeing something of a global bond sell-off at the moment, particularly with the focus on Europe and Germany, with those bund yields rising again. A lot of this obviously linked with what we're seeing in trade, but also significant spending afoot in Germany.
Yeah, and most of it's to do with this, fairly historic change in German attitudes, if nothing else, to its fiscal settings, and maybe, quite practically what it intends to do with its balance sheet to be able to fund what is looking as though it's going to be a fairly extraordinary spending spree on defence and remilitarization. Of course, it's not just the Germans as well. We've got, the European Commission over the last week, floating its Rearm Europe plan, which would also involve about 800 billion euros of spending, which, although the details of how that would be funded are a little bit scarce at the moment, there is still the notion that we're going to see this, really significant fiscal spend coming through, European states and European economies, and subsequently on top of that, excuse me, subsequently on top of that as well, a real discussion about, greater fiscal unity in Europe. But, we are looking at, I think in about 2 weeks' time, an actual vote within the Bundestag on the sort of notorious German debt limit, or I should say debt brake, which has, been one of the functions kind of really depressing European economic activity over the last 10 to 15 years, because one thing that kept Europe's economy really in quite a stagnant space is that there wasn't a sufficient level of sort of fiscal impulse, partly because of structural reasons. There's no sort of fiscal union within Europe. But the economy over the last 10 to 15 years that could, really provide that kind of strong balance sheet to sort of stabilise European demand was Germany, for ideological reasons, as well as these kind of very practical reasons around the debt brake. On top of that, too, probably a desire to protect its export-driven growth model. The Germans haven't really exercised its balance sheet particularly much. Deficits were still, in the low single digits, in compared to sort of as a percentage of GDP. The debt to GDP ratio in Germany is only about 60% when you compare it to sort of 90, 100, 110% to other economies across the region and comparable economies across the world. So this is a really significant shift. There's a massive sell-off in bond yields as market participants now price in this extra issuance and this extra stimulus coming through. But in saying that, this isn't hurting asset valuations on the basis that it is expected that although a lot of this spending will go into the defence sector, there will be a multiplier effect because of the kind of expansionary fiscal settings, where there will be sort of the proverbial rising tide raising all boats. So you've got the DAX at basically record highs, other European indices doing the same. So really significant in the currency market too, because it's pushing the US dollar lower. I don't think it can be understated, a really historic moment for, the European Union and how the European economies manage themselves.
And also I've noted, of course, the ECB cutting rates again to 2.5%. That was expected.
Yeah, more or less that 25 basis points was, all but priced in, and the guidance was about the next April meeting, which sort of left the door open to another cut, and we saw some sort of choppy trade on the euro or in the euro last night on the basis of that. But there was real caution coming through the commentary from Madame Lagarde about the outlook, really emphasising now the risks that trade has the trade war might have on European growth, but also expressing confidence that inflation will continue to moderate going forward into 2026, and that the 2% inflation target should be hit by early next year. Obviously, largely because of the kind of weak economic activity and weak growth pulse where we have seen coming through the Eurozone over the last 12 months or so, that kind of really stagnating economy that we've seen in most parts of Europe. So again, it was a pretty much as expected turn or meeting, I should say, from the ECB, but certainly it keeps that April meeting live, and we'll continue to look at that data too for any signs that some of this trade uncertainty is manifesting in the growth outlook for Europe, because if it does, as it is manifesting in the United States already, very, very early signs, then again, another rate cut is certainly on the table at the next meeting.